What's up, guys? Today I'm going to be going over the basic of stock options trading for those who don't know what they're doing. Those that see these charts and they're like, what the hell is this? Like, what am I using this chart for? And like, do I buy and sell here? No, you don't. So you're going to need two apps, right? You're going to need TradingView to view the charts and Webull to basically place your trades, right? You don't place trades on TradingView. You see the buy and sell button. You could do that if you're buying the whole stock, but we're not buying the whole stock. We're doing options. And what are options? So basically, there are two contracts, right? You got calls and you got puts. Calls means you're betting the price is gonna go up. Puts means you're betting the price is gonna go down. So when we're in an uptrend, or when you try catching these trades, you're gonna want to try catching moves like these, and then that's when you try placing some calls, and you'll make money when the stock goes up, like with this. But if the stock goes down and you're in calls, then you'll lose money. And then if you want to make money when the stock goes down, you catch a downtrend, catch a pullback, enter in puts, and then that's your entry. Kind of ride this, like react to the market, don't predict. Um, Otherwise, that is actually gambling. That's basically betting. Um, I don't like using the words betting, but for simpler term purposes, I've been using those words. But yeah, the stock market is coming down right here. If you play some puts, you'll make money when the stock market goes down. Um, but if you're playing puts and the stock market is going up, then you're gonna be losing money. Yeah, and then you guys are like, what the hell? How does that happen? So, um, stock options trading basically is buying and selling contracts that give you the right but no obligation to buy or sell that stock at a certain price. Basically, in simple terms, a contract you hold 100 shares is valued at 1,500. Under contract is priced at 150. So say you're holding like 100 shares that are worth $15 each. Um, that entire basically that entire order is gonna cost you 1,500. But under contract, it's going to be worth 150. So you bought that contract for 150 and you're not required to buy that I mean, you're not required to buy the 150. Fuck. You're not required to buy the 100 shares that is worth 1,500, you know? I'm hoping that makes sense. Um, yeah, since you have it under contract, you're not required to buy it, but you could sell the contract. And that's how we're basically making money by selling these contracts. Um, Options and contracts mean the same thing, by the way, and trading means buying and selling. So we're buying and selling these contracts. So once the value of the stock goes up, the value of your contract goes up. So say you have 100 shares and it's valued at 1,500 and you have a call. And your call um, is probably like at 16, right? Like each one of these shares costs 15 bucks. And you have a strike. Ah, fuck. I'm gonna explain it to you in like house terms, cause I'm gonna lose your guys' yeah. All right. So those who don't get options, let's say you have a $300,000 house under contract by some owner who's trying to sell it. You you guys have like a contract that expires in 6 months, and that contract is worth 4,000, saying you have the right to buy the house, but you don't have to under the price, which is 300,000. All right. And then we have two scenarios. Scenario one. This is if you sell the contract. So this is what we actually do. We sell the contracts in the stock market. So 5 months go by and the house goes up by 50%. And 50% of 300,000 is 150,000. So now that house is worth 450,000. Your contract value is no longer 4,000. You could price it at like 10,000 or 4,000. I mean, not 4,000, 10,000, 8,000, however much you want. But let's say you price it at 8,000. Since you're holding that contract, you can sell to a person who actually wants to buy the house at 300,000. So say you don't have 300,000 in cash, right? Say you don't have that, but someone else does. So you could actually sell the contract, since that contract you're holding is the owner agreeing to sell you that house at 300,000, and since it hasn't expired yet, you could still um, buy the house at 300,000. Or if you don't have the cash, like I said, you could sell it to like a real estate investor who actually does have the cash, and you sell that contract for 8,000, and then you make another 4,000 basically because that contract 5 months ago was worth 4,000, but since your asset grew, then your contract grew, and now that contract is worth 8,000. Same thing with stocks. Same thing with stocks. Um, but it moves quicker since we're day trading. This is more kind of like swing trades and stuff like that. You can still get 50% on day trading. You get like 50s, 30s, 80s, hundreds. You could get like 1,000% with like a move like this. And yeah, then you have the second scenario. Say if you want to actually buy the house for 300,000, the owner's required to sell it to you at 300,000. So technically you could buy the house at 300,000 and then sell it for 450,000, which is how much the house is now worth after those 5 months that went by. You'll make 146,000 profit, and after taxes it's obviously going to be lower, but this is kind of the most simplest way I could explain it. So it kind of takes this house example, but like in stock options example and like stock example. So say right now you have a contract. All right, look, Nvidia right now is worth 119.10 a share. Say you bought like 100 of those. I'm not the fastest in math, but I'm pretty sure that's worth 1,900. I mean 1,190. If you move like the decimal place a little bit. But yeah. Um, and you have like a contract that expires in like fuck. I'll just show you guys right here, bro. Right here, you got Apple. You have your expiration date right here. You have your expiration date right here, and then you have your strike price, and then you have the current price of Apple, and then you have your calls, and you got your puts. So we click calls at a strike price at 197.5, and right here you have like the expiration date. So this contract is gonna expire in 14 days. So in 14 days, you want Apple to kind of go up, and then right here is kind of like your order. Right here you got your order type. Um, it will kind of show you this. It's going to be limit and market order. I use limit order because um, I'll show you guys. I'll tell you guys why I use limit order in a minute. But yeah, then you got your limit price. So this is actually why I use limit order, because right here you got your thing called the mid price. The mid price is basically how much the contract is worth at the moment. So right there you see mid price is called. It's at $3.55. You want to get your limit price close to $3.55. If anything, put it exactly at $3.55. And then you select the amount of contracts you want. And then you could do one, two, three, four, five. You could do however much you want, depending on your capital. And then this number is actually multiplied by 100. So $3.60 is multiplied by 100. This contract is going to be worth $360. And you could buy more. You could buy like 3 contracts. It's probably going to cost you like 1,080, something like that. And then you just hit buy and confirm, and then boom, you're already in a trade. You're already in a trade, and then you could watch Apple. Right now, Apple's at, oops. Right now, Apple's at 222 and 50. So say if you put this to expire a little bit more ahead, then you'll be banking right now. Right now, if this order was actually in on June 21st, let's see how much Apple was at on June 21st. Just out of curiosity. Wait, when did that expire? Yeah, 21st of June. Ah, you would have been up hella. Yeah, because if you bought your contract right here, saying the stock is gonna go up crazy, then yeah, you're basically buying the stock right here. You're buying 100 shares at 197. 0.5, and then it kind of goes up, and then you kind of just sell. You don't have to sell on your expiration date, but you could kind of sell right here because I already went up hella. Oh wait, I'm tripping. Oh wait, no, yeah, you're gonna sell right here. You're gonna sell right here, or here, or here, or here, or here, or here, or here. You can sell whenever. Um, Obviously, when you place this uh, contract, you can sell whenever. Um, say Apple goes up and it's at like 200, you can still sell your contract because, yeah, you make money if it even goes up a little bit. Then you got your Greeks. Hold on. You got your Greeks. So personally, I hate the word Greeks, but yeah, you don't have to kind of watch these every time, but it's something to keep in mind. When you're holding these contracts, you got your delta, gamma, theta, and implied volatility. Damn, I said titty. Implied volatility, uh, also known as IV. Um, you kind of see these right here, you know? You got your delta, gamma, theta, volume, and IV. Right here, you have your delta, gamma, theta, volume, and IV. And that's on calls and that's on puts. Basically, you're trying to calculate how much you're going to make if you were to buy this. And this kind of delta kind of calculates how much you're going to make if Apple moves up a dollar. So if Apple goes up a dollar, your contract is going to go up $50 because this is you kind of move this decimal two places to the right, and it'll be $50.41 if it moves up a dollar from here. And then your gamma kind of adds to your delta. So right here, 1, 2. So your gamma changes your delta. So you're gonna have $4.33 added to your delta. So then your new delta will be uh $54.33, or it'll probably be 50. Let's just round it up to 55. So now your new delta is gonna be 55. So now every single time Apple goes up $1, um, you're gonna make 55. So if this goes up $2, then you're gonna make like 100 and like $106 something, and if it goes up another dollar, then you're probably gonna make like 100 something else. Um, Obviously it's the same if it goes backwards. Um, yeah, and then you got your theta. So theta, you don't really have to worry about it too much if you're playing like weekly contracts or like monthly contracts. You don't really have to worry about theta. The only time you worry about theta is like when your contracts are not like they're not reaching your strike price and you're getting cooked. Um, Say you had like weekly cons and right now um, you're getting close to the expiration date and you're like $3, not $3, you're 3 days to the expiration. Once you get into like the second day, then you're gonna start getting cooked. Like your contract is gonna be worth less and less. As soon as it gets to like zero expiration date, which is zero TD, then it's probably gonna be worth like less than 100 or like less than 200 or something like that, depending on what you got. Unless you're like already in the money or like far out the money, then you're gonna be fine. But even then, um, try not holding your contracts for too long unless you're swing trading and like you're in the money, then yeah, you go for it. But like I play a lot of zero TDs. Zero TDs means zero to expiration, or like a couple days out, like 5 or like 4. And I try not holding my contracts for too long because the longer you hold your contract, the less valuable it goes. Unless you're obviously in the money. Unless you're obviously in the money, and unless you're like it's actually going your way, then yeah, you could hold it. But if you're playing zero TDs, yeah, your contracts are gonna expire that same day, and it's probably gonna go all the way to like zero and stuff like that. So sell your zero TDs and like all that shit. That basically explains your Greeks, and then what company should I trade. So It really doesn't matter what companies you trade. I personally trade SPY and QQQ and whatever lies under that. So it'll be kind of like Apple, Microsoft, Nvidia, Amazon, Apple, Meta, Netflix, AMD, Microsoft, Google, and so forth. You can kind of look it up yourself. But yeah, the only things you gotta kind of keep in mind is just don't trade like no unusual stocks that have like low volume. Always have a stock that you're trading that has like volume. So like the S&P 500. This is always like very volatile. QQQ is always volatile. SPY is always volatile. Apple's volatile. Tesla's always volatile. All that. You could trade those. I trade SPY, QQQ because they always have like people trading those. Nvidia and like Tesla. And then you guys have your times right here. You could. This is Pacific Standard Time, so this is Vegas time, so this might be different for you. But obviously market opens the same time. So 6:30 a.m. to 9 a.m. I mean 6:30 a.m. to 8 a.m. You get like the most volume, the morning volume. You got 10 a.m. to 11 a.m. So after 8 a.m. volume kind of dies a little bit. You could come back at like 10 a.m. and then try looking for another trade to see if volume kind of picks up. And then you got your power hour, 12 o'clock to 1 o'clock. Um, yeah, power hour. I don't trade power hour anymore, but yeah, if you want, you could look for a trade on Power Hour, but it'll usually be from 6:30 a.m. to 8 a.m. or like 10 a.m. to 11 a.m. Either one of these two, I'll trade. Right here, I don't trade that much, but those are like the most volume times that I've seen the market at. And then SPY and QQQ, basically these are ETFs. So if you ever want to get into like actual investing, you can invest in SPY and QQQ that kind of track like the best doing stocks and they get rid of like what is not doing good. And yeah, so a lot of these companies actually follow SPY and QQQ. So right here you can see QQQ kind of going up. That's because Nvidia kind of went up. Um, you can see Apple kind of coming down. Um, you can see Meta coming down. You can see kind of like familiar movements. You could kind of see Tesla going down. Um, I'm pretty sure right here that's when they went down. But like, yeah, on SPY. I'm not sure where SPY is at. Oh yeah, it kind of went down, but we're kind of recovering a little bit. But yeah, usually when you see SPY green, then the entire market's probably green. You could look for calls, or when you see SPY red, then the entire market's not entire market, but like the stocks that are under SPY or like under QQQ or like the S&P 500. Um, the stocks that fall under in that category, they're probably red or green if SPY is red or green. So you can always check SPY and QQQ first before you start looking at anything else. And then how much should I trade with? So basically, $500 to $1,000 is perfectly fine. Um, or in my opinion, that's the best because these contracts, especially with SPY and QQQ, they're like $100 contracts, $80 contracts, and all that stuff. And you could buy like two or three. Just like try buying like a little bit when you have like a smaller account. Um, obviously, if you don't have 500 or 1,000, or if you're scared to lose this much, I recommend paper trading first. But overall, my recommendation is $500 to $1,000. I don't want to change my opinion. Obviously, you could trade with $100 and try taking it to 1,000, but bro, you already need a skill set for that. But if you're trying to work with the skill set, or like build the skill set, I recommend paper trading first, and then start off with 500 to 1,000. Um, and yeah, but if you're profitable paper trading, then you'll for sure be profitable um, trading with 500 to 1,000. If anything, you don't have to use the full 500. You could be in a trade. Um, like say you have 1,000 or like 500. Let's just say you have 1,000 in your Webull account, right? Um, but you don't have to be in a trade with the whole 1,000. You could be in a trade with like 10% of that. With so basically 100. So you could buy one contract of something, and you're hold on. Is that my mic? All right, my mic. I thought my mic cut off. But like, say you have $1,000 in capital, and say you use 10% of that, which is 100. You could be in a trade with like $80 of that 100, and you could set like a stop loss at like 20% or like 40%. Uh, 20% of 80, I'm pretty sure that's like that's $16. So you could lose like $16 out of an $80 trade. Um, Obviously, if you have more money, then you're gonna make more money trading, or like if you're like more confident, and if you're like in heavier positions, you can make more money when you're trading. I say 1,000 is perfectly fine. 500 is also pretty good for beginners. For making like that $30, $50 profit. 1,000 you could make like, well, me personally, I'm in trades with like $800, so I could make like $300 off a trade, $400 off a trade sometimes. Yeah, but yeah, you guys could read all this to kind of motivate you. Basically, it just explains that a lot of people just spend so much money, bro. And bro, sometimes you gotta just take into consideration that instead of spending $300 or like $500 on like going out and stuff like that, you could actually kind of use that money to kind of learn, kind of just focus on yourself. Right now, since I'm young, I kind of took the risk because, bro, I don't have like that much bills to pay. Bills are not a problem to me, and now the money I use to basically go out, like spend or like get some shoes and stuff like that. Um, I use it to learn how to trade, and yeah, I kind of lost a little bit. Obviously, I lost in the beginning, but it's cool. I decided to learn, and then as soon as I learned, I made all my losses back. And yeah, this is basically a skill that I'm not gonna lose ever in my life. But yeah, that's basically what I recommend, 500 to 1,000. And then yeah, basically this is like a lot of just yep. Oh, averaging down, protecting your cons. All right, this is gonna be a little bit complicated, but it's not really. So say say you bought 5 contracts for $360, and that's or no, say you bought 5 contracts at 3.60. This is obviously multiplied by 100, so your 5 contracts are worth 1,800. Say it kind of goes down, right? It kind of goes down, and now it's worth 1,500. Um, but you kind of average down, right? You average down, and you average down to 3.50. Now you're in with a trade with $4,575, and since you average down, now, when it goes up a little bit more, then you're already going to be in profits already. So you'll be closer to profits, you know? So if you buy high and then you buy a little bit lower, and then once price kind of starts moving your way a little bit, um, then yeah, you can start making more money than if you entered in your original position. That makes sense. That should make sense. You guys should understand it. And yeah, basically that's the basic of stock options trading. Again, we're using TradingView to just view charts and stuff like that, and we're using Webull to place our options. You're gonna get like shit like that. You're gonna get this type of screen and stuff like that. You guys should be able to learn, bro. It doesn't take like some. It's not that hard to understand this, bro. It's really not that hard. It's not that hard to buy anything. Uh, it's really not that hard to understand this. But I'm always willing to help. But yeah. Let me know if you guys have any questions. But yeah.